Hey, today we're going to talk about
Finance, life, all of these things.
about investment.
Exactly.
Yeah.
Yeah. So I'm John Dasson. I'm a Wealth Advisory Director at Financial Alliance. It's my 13th year at the firm here, Singapore's largest IFA, and it's been a very enjoyable 13 years.
Hi, I'm Kenny Loh. I'm also the Wealth Advisory Director from Financial Alliance. I have been with the company for about 8 years. I help a client to build a diversified portfolio consisting of different asset classes to achieve an optimum risk-adjusted return. Hey, John, you have been with Financial Alliance for 13 years. How do you get started into this journey?
Yeah, well, 13 years, well, it's flown by. I joined directly after university and started from there. We initially, I mean, in this industry, a lot of people do cold calls. I really don't like the idea of it. I feel it cheapens our business and our image. So I started up with my warm market, talking to people that I knew, contacts that I had, and started from there. Referrals came in, and I started with everything: investment management, wealth protection, so your insurance, doing wills and trusts, loans, mortgages, refinancing, and from there the business just grew organically, and 13 years have flown by. And yeah, along the way, obviously, with our knowledge that we have as practitioners, I mean, I've tried to be as frugal as possible and invest as much as possible over the past decade, which has been good.
Wow. Actually, you are in 13 years. I'm only 8 years. Actually, I'm your junior, although I look much older than you. Right? Actually, I joined this industry basically by accident.
Okay.
I was in the corporate world last time, working for close to 20 years of corporate world. Then after that, I did meet a career changes during my midlife. Some people call it midlife crisis, but one of the advisors told me that actually we need to be think more positively. Instead of midlife crisis, we should consider as a midlife. So in that case, share with me that how you get started along the way, and from a newbies, because every one of us actually we start from newbies, right? Until now we become the financial advisor helping our clients. So what would your journey looks like?
For me personally, I like to follow a simple approach. What I like to do, I like to do something called the 3-bucket strategy, whereby I think in terms of timeframes. So my first bucket is 0 to 3 years. Funds that I need liquid within 3 years. Second bucket, medium term, 3 to 10 years. And the third bucket, long term, so like 10 years plus. Retirement, really long term needs. So what I do is I ensure that whatever funds I need for that time frame, I keep it in an investment relevant to that time frame. So obviously, if it's 0 to 3 years, I'm very conservative. So I look at things like fixed deposits or money market funds. Now T-bills obviously have a good return. I mean, reducing now with the latest US Fed meeting, but still attractive, right? So that's my 0 to 3 year bucket. My medium-term bucket would be a portfolio where there's likely equity, maybe more fixed income instruments. And my long-term bucket would be primarily all equity. So this gives me the confidence that I'm not ever going to face a scenario where I may need liquidity and I need to access the portfolio while it might be in a negative situation. So with that confidence, it makes life easy, right? If the equity market goes down 15%, I'm not worried because I know long run the markets are going to pick up. And it's in my long-term silo, my medium-term silo. I'm not worried that I need these funds for my mortgage refinancing to pay off some of the mortgage in 2 years. So it allows you to sleep easy, and I like it. It's simple, allows easy management of the funds and stress-free.
Yeah. Actually, my approach will be slightly different from you, but more or less, I also allocate to the short term and long term. But for me, because I am really moving into the retirement, and also my client base, basically they are more also prepared for retirement. My strategy is mainly more on the defensive first before we talking about attacking. What does it mean by defensive first? Before we attack, basically I help my client to build out the defensive portfolio comprised of the CPF Life, because that one you can provide a lifelong regular income. At the same time, also building out the dividend portfolio comprises of some of the maybe bond unit trust, REITs, or some dividend stocks. So once the client build out the regular income, that kind of portfolio, then the asset fund itself, they can actually take some higher risk, right? Participating in maybe cryptocurrency or some growth stock or maybe China equity, that will help the investor to boost up the return. But of course, one of the very important strategies is diversification. So along the way, throughout this all in the experience, starting from as a newbie investor until a professional financial advisor, I think diversification is one of the biggest takeaway I'm helping my client and even for my own portfolio itself.
Yeah, I think that's excellent. I do something similar. So CPF Life, I think it's excellent in terms of a safe asset giving income at a pretty good internal rate of return, pretty good yield. So I really like that for retirement planning as well. Yeah. Well, I think I have seen in certain investors sometimes who may not have deeper knowledge of markets. And if a friend tells them, hey, there's this particular stock that is going to do well, they think it's a good tip, a hot tip, and they put in a very large chunk of liquidity, of money in it, without thinking in terms of time frame, without diversifying, thinking whether that asset class actually matches what their investment objective is from a risk-return perspective. And when it doesn't go according to plan, which often can happen in the short term for equity, they panic because they don't think of the long-term data, and it's not diversified also. And then they end up liquidating at a loss. And then they may lose 30, 40%. And then they're scarred, right? They think investing is not for them. They think markets are so volatile, it's gambling. And that can be a waste, right? Because then it ruins their entire financial journey in terms of a investing point of view. So I've seen that happen. I've also seen certain clients maybe get taken up by certain investment structures that are not regulated and are propagated by certain salespeople, and it may be like a scheme where you put in $1,000 a month and then they pay you back. But then what is the underlying asset is very murky, it's very unclear. They may say gold, but how is the return generated? And it just looks so much like some sort of scheme, right? But when someone doesn't have that expertise in questioning critically an investment structure, this can happen. So that's one of the big mistakes I do see happen. What about yourself?
I'm thinking, because I also a trainer for myself, I have a chance to really train the retail investor and also guide them along the way. I think the biggest mistake they are having now, besides we are talking about product or understanding the underlying, basically they do not have any clear mind when it comes to investing. They do not know why they have to invest at the first place, whether they need the money for their new home or for retirement. They don't have a very clear goal. So along the way, they are just investing for the sake of investing. Then along the way, if they need money for their newborn children, or they need money from their new home or retirement or for medical expenses, they start to switch. All right. So setting up a clear goal with a time frame in mind is very important when it comes to investing. And also, like what you said just now, they have a different bucket. Some of them may be for the home, some of them may be for the children education, and some of them may be for the retirement planning, because each of them have different risk profile. At the same time, also have the time horizon. So I think that is the biggest key takeaway investor probably have to pay attention to. Set the clear goal up front first, because once you have a goal, for example, you want to drive to Penang. Penang is the goal. But along the way, you may be encountering traffic jam or stuck in custom, right? Immigration, or maybe some of us, we want to reach Penang in the shortest time. But some investors along the way, when they first started off, I want to reach Penang in 3 hours, which is not possible. Maybe 6 hours or 7 hours, but you have to drive at that kind of speed. But along the way, they find that it's too fast for me. I need to change. So I even experienced that during the bull market itself, most of the investors come back to me, I want to be aggressive portfolio because I want to have achieve maybe more than 10%. But during the market turn bearish or market downturn, then they start to change the risk profile. I cannot take it anymore. I want to get out. I want to reduce my risk tolerance. So these are the common mistakes that the investors are facing. Is it more on the emotional side? It's nothing to do with their goal or maybe strategy. They are just not able to manage the emotion. That's why when it comes to investing, I believe that you strongly agree that emotion management is very, very important.
Yeah, I completely agree. What you said about not having a clear objective, clear time frame is so common. And also about being able to switch in terms of a market downturn, manage that psychology behind the investment. And I think a lot of our job ends up being managing that for the client, because to them they might think the market is falling, why don't we exit? But we know that it's so hard to time the market sometimes. If you already have a paper loss, why do you want to realize it? When you know historically, when you look at the data over the past 50, 60 years, this might actually be a good time to invest and catch the bottom or tranche into the market over a few months. So I also feel the same. There's so much of emotion management in this role, which is interesting.
Yeah.
So for younger investors, I think that you have this huge amount of time, right? Let's say a 30-year runway where you can let your investment compound. I think Einstein is attributed with the quote that compounding return is the eighth wonder of the world. So when you look at the numbers, I think I've got the figures for, let's say, an investor who invests from age 25 and he invests for 11 years, $750 a month at a rate of return of, say, about 8 or 9%, long-term equity rate of return. And he stops investing at 35. And he keeps it all the way to 65, versus an investor who starts only at 35, invests all the way to 65. So 30 years versus 10 years worth of investment. And you'd get roughly about half of the investor B, who invested 3 times more, would only have about half of what investor A invested. So compounding return is your best friend when you're young. So that's what I would tell young working adults. Be frugal. Don't think about impressing people with unimportant things. Don't care about what people think. You don't care about these people, right? So be frugal, save up, invest it wisely, take care of your family, do all your things they need for security, but grow your wealth. And it will pay off in the long run, far more than buying flashy things which depreciate for the first 10 years of your working life. It has a huge difference. That's what my big advice would be. What about yours?
Yeah, basically I can summarize into trading. I was young before, right? If given a time machine, I would want to restart and do the right thing, right? So I think first of all, I have to start early. I start my investing journey at about 40 years old. I should have started after I graduate at 25 years old, right? So I totally missed the first 15 years. So start early as much as possible, and at the same time just get themselves educated as early as possible what is the investing all about, because there are so many free resources out there in the YouTube, in the Instagram. There are so many. There's no excuse why they cannot get educated, but whether they can get educated correctly or not correctly is another story. So start early, get educated, and the third one is make sure they put their hard-earned money in the stock market. Start small. Because one thing investors do not realize is the emotion management of their inner self. They need to understand themselves, what is their risk tolerance, and whether they are able to sleep well with their own investment. So that portion, actually nobody can guide them. Nobody can teach them. You cannot learn the emotion from books. You cannot learn the emotion from YouTube. But you can learn when you put your hard-earned money. I'm not talking about all those paper trading. Paper trading cannot get your inner side come up, right? What is the emotion means? How, as an individual investor, how are we going to deal with the greed and fear in our inner self that will determine whether how successful we are when it comes to investing. Then, of course, the last one, the most important thing is have to be perseverance. have to ride through the bull and a bear cycle. Because a successful investor, they are always they are able to ride through the bull and bear cycle because you know what is going to happen and what are the opportunities during the bear market. Because bear market is the best time to accumulate wealth. Then that bear market can provide the opportunity for investors to shorten the wealth accumulation period. But unfortunately, due to the inner fear, the psychology, nobody dare to invest during the bear market. So these are the experience I learned throughout the whole years. Now I have already shifted my investing strategy. I always look for bad news to invest, right? When there's a blood on the street, that is the best time for us to go in. But we need to make sure we go in with the eye open, right? Choose the fundamentally strong investment instrument or strong stocks or strong REIT, and just be confident and also ride to the volatile period. Over the long-term periods, basically the return will come.
So I completely agree. I like the idea of investing when the market is down. And when you identify particular stocks, particular REITs, which you think have good value, and the market sentiment is just against it in the short term, if this is going into like the 3-bucket strategy or long term, you're not concerned about the next 3 years.
Yeah.
You're thinking long term, 5 years, 10 years, 20 years. So even if it's an ETF or say an actively managed fund, I think that's the best time to invest. And it's very hard to catch the bottom, but you don't have to, right? When you look at the data over the long term, you don't need to be at the absolute bottom. If you are buying in relatively close to the bottom, you're going to make handsome profits in the end. So I like the idea of tranching into the market, maybe with a certain investment size, breaking into a few tranches, investing maybe over 6 months, and hopefully catching the bottom. If not, it's okay because you've got this time. So I completely agree. I like the idea that when the market is down, it's basically things on sale. And obviously, you'd rather buy on sale than at full price or an inflated price. So I completely agree with that strategy.
Based on the past 2 or 3 years, because of the COVID and also the high interest rate environment, surprisingly, that Singapore REIT sector actually facing an unprecedented problem in the REIT sector itself. So there are approximately about 10% of the S-REIT actually get into trouble. Some of the S-REIT, they declare that no dividend being paid, surprisingly, because REIT used to be paying a good dividend, but there are 2 REITs actually suspended the dividend. The reason being is because they breached some of the debt covenants, which is more on the gearing ratio side, and the creditor they want the REIT itself to really make the immediate debt payment. So in short, when the interest rate is low, basically the debt or capital management side is not playing a so crucial part. But under the high interest rate environment, actually investors they should pay special attention into the capital management, because some of the REIT, their balance sheet has been damaged. When the balance sheet has been damaged, that means that they may be facing the difficulty to refinance their debt, or they are not able to meet some interest coverage ratio. That may get themselves into trouble for the REIT. Okay, so when the REIT get into trouble itself, they either have to sell off their property to reduce the gearing or make the payment, and that will indirectly or directly affect the DPO payout. DPO stands for distribution per unit. So in other words, it's the dividend. So investors need to be very careful that during this period when they do the REIT selection. Actually, for the past 2 years, we also have some unprecedented event that both equity market and the bond price come down. So actually, no investor was spared during I think 2022. Somewhere in 2022, we have the equity market down and also bond market also down. So it's very important that we need to diversify our portfolio away with the alternative investment. So if the investor have 100% allocation in the stock market, traded that kind of investment, they probably will have see a big dent in the portfolio. Then basically the whole portfolio can see basically it's a paper loss. So diversify into the alternative investment can help the investor to really have some cushion, because alternative investment basically they are not really traded in the secondary market. When they are not traded, basically you don't see the price moving up and down every day. So what are the alternate investment out there that the investor can pay attention to? They can consider maybe some trade financing. because trade financing basically is just doing the financing on the trade side. As long as the world economy is moving, there is always the need for the trade financing. Trade financing is some sort of financing also offered by the bank. But now the fund manager, they have created a fund to really give some alternative solution to the business itself beside the banks, right? Second thing would be more on the private equity. Instead of investing in the listed company, investor also have opportunity to invest in the private company and also participate in the growth of the private company. They are not listed, and there are some of the fund also focus on the merger and acquisition. So merger and acquisition, basically, that takes some time to see the return. This fund, some of the fund that actually Financial Alliance offering, basically, you know what is that? They are pooling the investor money together and look for company or look for some a good company to do the acquisition. Then after that, do some restructuring of the management team to grow their revenue, to grow their EBITDA. Then after that, they look for the new buyer to exit at the higher profit margin. So these are the alternate investment that investor can really diversify into. Of course, we also have a crypto fund, right? Crypto is another new asset class. Do you believe in crypto, John?
Well, so this crypto is such a big space in itself, right? And I think, like you said earlier, one of the major advantages of alternative investments as a whole in the first place is having uncorrelated returns to your traditional equity and bond. And in times of certain volatility, it's good to have that as a little anchor weight to the portfolio to just provide that uncorrelated returns. And I think crypto as an asset class, over the past couple of years, with the equity markets dropping, bonds suffering due to interest rates going up, the crypto market also has taken a massive beating. There's such a big rosy picture of Bitcoin's potential, but at this point, I mean, it's obviously suffered. Over the past month, prices have come back up a little bit, but it's still far from the lofty heights that it's reached in the past. So do I believe in crypto? I personally am invested in crypto, but in a very small portion in relation to the rest of my portfolio, which is real estate, equity, and bond. So I like having it, but it's a bit of an experiment for me, I think. And I'm holding mostly blue chip cryptos. I know there's lots of people who trade cryptos, trying to find opportunities in the volatility, but my knowledge is not deep enough to really trust a large allocation towards that. I still prefer the idea of a crypto ETF or a fund for that space, or holding blue chip cryptos like your Bitcoin and Ethereum. So to me, it's still experimental. I like having it, but it's in my bucket number 3, long term. Not gonna rely on it anytime soon. Yeah.
Actually, I strongly believe in cryptocurrency and also blockchain on the Web3, that kind of application moving forward. Because one thing is pretty clear, moving forward, maybe 5 years down the road, 10 years down the road, definitely we'll be entering in the cashless society. We have seen it in China. And Singapore, we have a partial payment in cashless. So we can use this kind of cashless payment moving forward. And in order to have a cashless society, we need all this kind of infrastructure, right? So there will be the technology disruption coming in to really disrupt this whole space. And we are at the present moment, we are at the infant stage. So when you have an infant stage, there are a lot of risks and also opportunity out there. We do not know which one can be successful and which one can be failed, right? But how the investor can allocate into this special place, I agree with you, using the ETF, crypto ETF, and also the fund would be the better so-called solution, right? Instead of for us, we go and figure a way out which one successful, which one not successful. And because there are a lot of technicality over there, we may not be really familiar. And the other one more thing is very, very important. People lose money in the crypto is not due to the price volatility. I'm not sure whether you understand what I mean or not. It's not due to price. It's basically people lose money is because some of the unregular exchange being shut down. That's one reason. The second reason is a very lame reason. People forget about password. People forget about their private key. So no matter how much crypto you have, once you forget about your private key or password, that's it. Your crypto will be vanished in the universe somewhere, right? And the other important thing is when when they want to invest in a crypto, they also need to have an estate planning in mind, because our family member, no one where we keep no one know where we keep the cryptocurrency. At the same time, they also do not know how to access the cryptocurrency. You can, because I believe that you have invested in some of the crypto, right? You can ask your wife, do you know where you keep all the information, right? Right. So how she can retrieve all the money when for family if there's an urgent need. So I think that these are the things that investors need to pay attention to, and also need to uh, put all this kind of crypto asset into their estate planning.
So with that asset planning, estate planning angle, what I do personally, what I encourage clients to do is when they have their will, ensure they have an up-to-date statement of assets. And I like to update that often. So I have a statement of net worth for our assets, and I update it monthly. Once our pay comes in, once we send it out to our various investments, I update it monthly at the end of the month. And it's good because then my wife has the ability to, if anything goes wrong, everything is there with updated figures, our assets, our liabilities, individual accounts. So it helps because I like having the statement of net worth. It also makes it more, it motivates you to want to grow it, to be more frugal, and to invest more. So that's how I manage that potential risk.
Yeah. Do you plan any estate so-called distribution, the wealth distribution for your client when they have an investment portfolio with you? How do you do that?
So depending on their needs, let's say if they have children who are minors, aside from a will, I always advise them to structure it with a embedded testamentary trust to ensure that assets don't flow to the children when they may not be financially mature enough to handle large sums. When we talk about insurance payouts, investment portfolios, it can be very large sums. So the kids may not be mature enough until they're older. So I like having that family trust that is activated in the event that both parents happen to pass on. And when the kids eventually become a certain age that the parents choose, let's say 30, the full amount pays out. While in the meantime, they receive a stipend or an allowance of $2,000 a month, depending on what the parents want. So I like that from a family wealth protection point of view. And generally, having that statement of assets also helps to ensure that if that time comes, it's easy to find those assets. The only thing obviously can be more complex when we're talking about international assets, properties held overseas. Then very often what I'd advise is for the client to get a will done in that jurisdiction as well. So that even if this will in Singapore can be used, time is saved. In relation to the cost of doing an additional will, there's so many benefits. So I normally advise to get a will done in that jurisdiction.
Yeah, it's so important that we really, when it comes to investment planning, we have to take the estate planning into consideration, right? Because when we are still alive, we know everything, we know how to manage our investment, and we know how to, what will be the investment strategy. But one day, if we are no longer around, our beneficiary may not know 100% understand what we are trying to do. And also the other thing that I would always help my client when I plan the investment for them is a tax consideration. There are many people that have overseas stocks listed on other exchange. They forget about what would be the implication of the inheritance tax or capital gain tax or estate duty. These things are so important. If we don't plan it properly, basically we are paying all the tax unnecessarily.
I completely agree. And in Singapore, do you utilize schemes like the SRS for your clients to save on tax?
Definitely. Tax planning is one of the key things that you're trying to find money from your own self, right? Because if you pay tax to the tax authority, of course, we are contribute to the national building, right? But on the other hand, it's an expense to us. If we are able to save it, then we have additional money for us to really build up our investment portfolio or build up our retirement portfolio. So tax planning is also very crucial. So in short, actually, investment is not only just for retirement. There are many considerations inside, right? In order to have a holistic investment planning, we need to consider tax, we need to consider estate, we need to consider the return, we need to consider strategy, we need to make sure everything is regulated. So there are so many things to consider. So that is one of the key things that after I convert from the retail investor as a personal financial advisor, so professional financial advisor, these are the most important thing I have learned, the risk management portion and with a future plan in mind.
I like that. And to build on it, I really like using SRS to build up a client's retirement. I mean, like you mentioned, the tax savings, they can be significant. And obviously, when you're in a higher marginal tax bracket, very large savings, and those savings are guaranteed. So let's say it's 19%. That adds on to your first year ROI of your investment, which is huge. So to not make use of it is such a waste.
I hope the government can increase the cap. 15,300 is not enough.
I also think so. It would be great if the cap could be closer to the foreigner cap. Maybe
Right.
20,000. That would be nice. But with the personal income tax relief cap of 80,000, that also makes it a bit challenging when you consider CPF contributions and other reliefs. So that increased as well. That would be great. Yeah. Okay, so for clients who are nearing retirement, specifically, their needs and strategies are so different from someone who's younger. When someone is younger, they've got that long runway to really make use of compounding return. So they tend to be in more aggressive asset classes. If the market has a downturn, they have time to recover. But obviously, older investors don't have that luxury. And often their goal is about preservation because they've earned their money. Now it's about seeking income or yield from it. So very often, once we're in that close to retirement age, we tend to rebalance the portfolio, rotate assets away from riskier assets towards stable assets, paying a decent yield and where we can get income from. So we're talking about dividend-paying stocks, but those are still equity in nature, so you've got volatility. So then we're looking at fixed income instruments, bonds. We're also looking at things like your CPF Life, right? Risk-free way of getting a good return and income throughout your retirement. And then with that, there's always topping up to the enhanced retirement sum. So REITs, something you're very familiar with, is also an asset class that I really like for retirement. Again, equity in nature, so there will be some volatility, but with relatively stable dividends. So having a diversified portfolio in the most safe way to just attain what they need. If what they need is, say, 4%, let's say they've accumulated this size of assets and 4% of that value is enough to sustain their needs, then that's what we target. Because why take unnecessary risk? If we can just skim off the top and that can sustain them, then they've got all these assets where if they need, they can always draw down from. So I like planning from that angle, and I like looking at yield and income with preservation and taking as little risk as possible to meet their retirement needs.
Yes, I like our role as IFA. Because throughout the conversation, we don't talk about any solution. There's no solution, there's no product being mentioned. We are just discussing about strategy. That's the reason I joined IFA, because we can help clients to plan holistically without any influence by we don't have KPI from behind. We don't have a pressure to really promote certain product, right? We can use the CPF Life, we can use the SRS, we can use the SSP, T-bill, and unit trust, REIT, and so on and so on. There are so many products as an IFA we can offer. So after we define the solution or based on the customer objective, right? We can look for a different solution offered by a different partner. We have so many. How many business partners do we have? I think we have plenty. I lost count. So we also can use insurance as a complementary to our investment portfolio, and we also can use insurance to hedge our investment portfolio. People talk about using the hedging strategy in the investment, maybe using the short ETF or using some of the short strategy to hedge our portfolio. But if I'm looking at bigger portfolio for our client itself, we can use insurance as a hedge to really against any unforeseen medical bill, medical expenses, so that our investor or our client do not really need to liquidate their investment portfolio to pay for the medical bill. That you really help them to really protect and also preserve their investment portfolio for their retirement.
Yeah, I completely agree. And adding on top of that, when one major part of our role is connecting all the dots, right? It's not just about managing the sum of money within the silo. We can look at that in relation to the client's other needs, possibly paying off their mortgage because they are very conservative, having enough liquidity for the kids' education, having, like you said, enough in place to pay for medical bills, along with all their multitude of needs and wants and goals, and being able to connect all those dots and really advise them on what we would do if we were in their position in a completely unbiased way that gives so much fulfillment. And I think that's one major driver of me for this role, and why I think I can do it for until I retire, because you're really helping people solve issues and adding value and getting paid for doing a good job. So I think that's the good value of being an IFA.
On top of that, actually, whatever thing we do for our client actually is doing for ourselves, because the strategy we develop for ourselves actually can be replicated to our client. If you don't believe in it, it's very difficult for us to really convince the client, because we also never do it. So for my client portfolio, investment portfolio itself, and their investment strategy, and even for the retirement strategy, is pretty similar to mine. Right? So, and also on the other hand, it's easier for us to manage because we are all on the same boat. If I want to do some switching for my client, then I also doing a switching for myself, right? If I want to buy some insurance for my client, I also make sure I do it for myself before I do it for my client. Because as an IFA, if you don't believe in your own strategy, it's very difficult for us to really convince our client to do the same thing.
Yeah, so I'm exactly the same. In the end, my clients' investment portfolios reflect mine, because that's what my belief in the market is at that point. So it would reflect in the client's portfolio. And I think it also helps when clients know that you've got skin in the game somewhat, where if their portfolio is down, yours is down as well. So it's nice to put your money where your mouth is in that sense, and it helps you because you're totally convicted of what you are recommending. And you are really recommending what you do when you're in the client's shoes, because you're doing it for yourself. So I think it might be the same for many of our colleagues as well, because it's such a natural thing to do.
Yeah, it's very natural. Okay, John, I think time is running out. I think it's for us to conclude our discussion over here. Planning is one thing, taking action is another thing. If the investor, they are able to DIY themselves, I would strongly suggest that take action immediately. If they are not able to, I would strongly suggest that engage an independent financial advisor to help them to kickstart their journey.
I think that's excellent advice, Kenny. So we hope that you've got lots of good information from this episode, good value that you can bring towards your investing journey next year and the future. If you need good advice, don't forget to choose independent. Like, share, and subscribe for more content. We'll see you next time.